Hello, I'm Jill Fielding, and before I bring in the live audience and get started, I'd like to welcome you on behalf of Tigrant Learning to this programme. This is an introduction to property investing. It is, however, just an overview, and you will be covering all the topics in much more detail in your next trainings. So, enjoy the sessions, follow along with me in the workbook provided, and I hope you find the information useful for your future property investing career. Right, good morning everybody, and welcome to this introduction to property investing. We're going to have fun today, I hope. We've got a lot of information to cram through in a one-day session, so we'll get started straight away. And what we're actually going to cover is the 4 fundamental things that we need to understand when we want to invest in property. And before we actually leap in and buy anything, what we need to appreciate and understand are these 4 things. Number 1, how to assess the property market itself and what it does and where it's going and why. And the next thing we need to understand is the best place and the investment type for the very first one, because the first one is so scary, isn't it? Doing the first one is the most difficult one, because once you've done one, all the others are a lot easier because you've done one, you know. So getting the first one done is the tricky one, and it's a shame because it's the hardest one you'll ever do, the first one, and it's when you're inexperienced, so it's a bit of a shame. So the first one is scary, and then after that we need to understand and pick the properties that are most likely to go up in value. Now, we'll see in a moment that the property market generally goes up over time, but what we want to see as investors is we want to see and find those properties that are going to go up in value quicker than everything else, because that's the key to outperforming the market. And then the 4th session is how to create a strategy of some kind. You know, we've all heard the saying, if you fail to plan, you're planning to fail. So we need to have some sense of structure and strategy and plan that can give us some targets and actions to go forward. And of course, how to get the right information. So they're the 4 things that we're going to cover, and of course, most importantly, it's not only about the knowledge that you've got, because knowledge is all right on its own, but the fundamental thing is taking that knowledge and taking action on it, you know, because it's the action that you take on what you know that is important for your certainly your wealth creating career and anything else that you might want to do. So why bother? Why bother investing in property? Well, the fundamental principle number 1 looks like this: property actually makes money. It's still statistically the most common reason for wealth, certainly in the Western world. If you looked at the Times 1000 rich list, statistically the most common reason for wealth there is property investment or land investment. So it is the one vehicle that holds true over a very long period of time. The good thing about property investing also is that it produces profits or income for you in 2 varieties, and that's either as income, and that's regular doses, probably every month, and it also produces whacking big amounts for you in terms of capital appreciation, which generally come as one big blob at some stage in the future. So the fundamental principle number 1, and the reason why most people are attracted to it as a wealth creating vehicle, is that it is the one that makes money consistently over time. And of course, we've already alluded to the fact that property gives you jam today and jam tomorrow. So you get regular doses of jam on a monthly basis when your tenants pay you rent. So you get drop, 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 drop jam. But then you can store jam up in big jars for later on in the future. So it's the most flexible of wealth creating vehicles. And of course, the key to being a successful and professional property investor is to do both. You do both income and capital. You have jam today and jam tomorrow. You get regular doses of income jam, and then add to it big jars of capital jam as and when. And the good thing about this flexibility is that you can, if you set your portfolios up correctly, you can then decide when you want to take the bigger blobs of jam, let's say, in the future, when your daughter gets married or your son goes to university, or when there's a change in your life, you then got the option to capitalise and bring the money out. So it's most flexible for most families going forward. And of course, it's about assessing the market that enables us to understand which one to do when, because there are certain times of the market, certain cycles in the marketplace where it's more relevant to do income, and certain times when it's more relevant to do capital. So let's get going then on session 1 on how to assess the market. Now, we assess the market by looking at 5 fundamental things. Now, we always call this taking a ride. The A on take a ride stands for actual evidence. The R stands for the ratio of affordability. The I stands for interest rates. D is demand and supply, and the E stands for employment and economy. Now, if we can assess what's going on with those 5 fundamental things, we will be able to tell what state the market is in and where it might be going in the near future. Now, take a ride and the 5 fundamental things within it, it is an important mnemonic. It's an important set of information, because you can do take a ride on a global level. You can do it on a national level, you can do it on a county level, you can do it by town, you can even do it by street. And we might actually do that later on at some stage. So take a ride. If you look at those 5 fundamental things, it will enable you to assess a big market and a little market, because it's the same fundamental issues that impact every house price movement. So let's have a look at that and start with the actual evidence then. And what we mean by actual evidence is, what do we actually know about what's going on in the property market at the moment? Now, we know all kinds of things. We know, for example, this is a map of the UK for the 2013 property price movements. As I say, I'm going to be looking at the UK mainly today, but this can be applied to any country, anywhere, or to the globe as a whole if you want to. But looking at the UK, we can see that there are rises, and not quite so big rises, in different parts of the country over the whole of last year. But of course, a 1-year set of evidence doesn't really give us much to go on, because 1 year could just be a blip, couldn't it? So we actually want longer term evidence than that. So if we move that out to a 20-year movement, we can see again what's happened with the property market. And the more evidence we get, the stronger we know about the movements in the market, and the more secure our knowledge is, and the more we can rely on it, because we want to be totally certain when we jump into the property market. We want to be totally certain we know where it's going in the immediate future. So there's a 20-year view. There's another 20-year view going up to the end of 2013, where we have an extrapolated moving average on the market in the grey line in the centre there. So we can see that even though we've got the ups and downs, overall we have a movement that goes like that. Again, going further out, this is a 50-year growth chart, which again shows us, even though we've got some wibble wobbles here, overall we're going in this direction. So again, gives us certain comfort of where the market might be going. So there's our 50-year growth, but we can go even further out than that, because in the UK, certainly, we are lucky enough to have records on property transactions going back to just after the Domesday Book. The Domesday Book is a book that's been written by local area throughout the UK since 1066. And in parish records, we have records of property and land transactions way back then. And some smarty pants person at a university somewhere actually has extrapolated property transaction data from basically 1066 to date. So we have nearly 1,000 years worth of history there. And it shows us that over that entire period, the property prices on average have moved up by 10.2% per year. Now that's an extraordinary thing. We've got 1,000 years worth of history showing movement of 10.2% per year. And I just wanted to briefly talk about the rule of 72 here. And this is where we get an idea of how quickly a house price will double. And the rule of 72 looks like this. You take the number 72 and divide it by the percentage growth that you've identified. In this case it's 10.2. How long does it take an average property price to double with that kind of scenario? And the figure comes out at 7.05 years. So if you divide 72 by the rate of growth, 10.2 in this particular case, it will tell you how quickly the asset will double in its value. And in this particular case, it's 7.05 years. And I'm sure you've all heard that. People say, you know, a property price doubles 8 years, 7 years, that kind of thing. And that's where that information comes from, is this kind of assessment. So if you're looking at a property, you know, that you think is going to grow by 20% per year, you can do your extrapolation from that, and that always gives you a marker. But as a baseline assessment for you, you need to be thinking about an average property on average over 1,000 years doubles in just over 7 years. Now, as professional investors, as you all are or are all going to be, you want it to double quicker than that. So that's your baseline backstop target that you're going to be looking at, and you're aiming always to improve on that. Does that make sense to everybody? Yeah. Now, so the actual evidence tells us that overall and over the long term, property prices in the UK go up. Within that, there are wobbles. And I always reminded of the, you know, the song Wibble Wobble, jelly on a plate at this stage, because that's what happens to the market. It doesn't go up in a straight line like this. It goes wibble wobble, jelly on a plate. It goes up and down, up and down, up and down. And of course, it's those wobbles in the market that actually create the investment opportunities for us. Because if everything went up in a dead straight line forever, there wouldn't be any opportunity, would there? Because everybody would be doing that one thing, and it's only because of the ups and downs that property and shares and any kind of asset is any type of investment at all, because you're trying to find the peaks and troughs. Does that make sense? So it's the wibble wobble jelly on a plate that gives us as property investors the best opportunities to make the most money. So understanding the wobbles in the market is what we're about to do, because if we can pick the wobbles, if we can identify when it's down and when it's up, that's when we've got the maximum opportunity. And if we look at the last 20 years on this particular chart, you can see actually there's a big wobble there, but even within an upward trend there's little wibble wobble. And I'll bring this chart back up a couple of times and show you where I've taken opportunities at certain times of the market. Now, the fundamental principle number 2 is this. Now, this may be a secret for all of you, but everybody lives somewhere. Okay, do you all live somewhere? Mm-hmm. Yeah, oh, that's lucky then. So everybody lives somewhere. Now, there is no business where your potential market is 100% of the population. I mean, if you had a hat shop or a plumbing shop, your target market wouldn't be 100% of the world, would it? Property is the only thing where the business involved is approaching the entire population, because everybody lives somewhere. I mean, with a few minor exceptions, but nonetheless. And by using the figures for the UK, but of course, again, if you live in Singapore or Australia or something, you would do the statistics for your area. But using the statistics that came out of the 2011 census in the UK, we know that we have 63 million and some people living in these islands, of which 53 million are in England. I think that looks like a fudged figure for Scotland, don't you? Because it's too round. But anyway, Scotland has 5.25 million-ish. Wales just over 3 million. Northern Ireland just under 2 million. But I'm going to break down the number of population in England to demonstrate a point. The 53 million people in England live in approximately 22 million properties. So we've got between 2 and 3 people on average in every piece of accommodation. Now, the 22 million properties are split in over 3 areas. There are the owner-occupied properties, of which 65% of our population live in owner-occupied properties. That's 14.3 million households. Privately rented properties make up 18% of the marketplace, and that's 4 million houses, or accommodation units should we say, that are made up of privately rented accommodation units. And then socially rented council houses, housing associations make up the rest, 17% and 3 million. Now actually this is a fundamentally important statistic, and this has been a big shocker. When this came out, this was a big shocker, because for the first time in the history of certainly this country, privately rented accommodation is now the number 2 provider of all accommodation units in the UK, and has taken over drastically from the council. In 1980, 31% of all our housing was provided by councils or social housing associations. By the year 2000 it was down to 19%, and now in 2011 it was down to 17%, and the privately rented sector is the one that is picking up all the slack and is moving into the marketplace as the number 2 provider of accommodation. Now that is a big thing, because exactly the business we're in, exactly the business we're about to go in, is a massively expanding area. The social housing sector is not going to be increasing, it's going to be decreasing, and it's up to us to step into the gap and provide the housing for the people in this country and countries elsewhere. And the good thing about that is 2 things. First of all, we're working in an expanding marketplace, and again, there wouldn't be many businesses where you would have that default expansion built in. And secondly, councils have got to be nice to us, because we're actually providing housing for them, for the people that don't have houses elsewhere. So this is a big thing. Now, the opportunity for us as investors is this. Everybody has to live somewhere, and everybody lives somewhere all the time. So it's not that they live somewhere and then do something else. They have to live somewhere. Now, they only have 2 options: to rent or to buy. So at any one time, you always have a market. Now, what tends to happen in a standard property market is this. When prices are going up, people, and that includes the general public as well as investors, people tend to buy because they get belief in the market. So when the market is going up more or less in a straight line, the demand is always to purchase, because the domestic residential purchaser, somebody who's buying a property or somebody wants to live somewhere for their own home, they get encouraged because the market is going up, they feel buoyant, they get belief, and they start to buy. So that pushes prices up more, because demand comes into the marketplace, so the prices go up. So as investors, that is our opportunity to buy and invest for capital growth, because the market is going up. Now, what happens on the other side of the coin is this. When the market is flat or decreasing, the public at large don't buy properties because they get scared and they think it might not be the right thing to do. So they don't buy their own properties. So what do? They have to rent. So when the market is static or decreasing, as professional investors, that is our opportunity to provide rented accommodation. So because everybody lives somewhere and they live somewhere all the time, it's purely a case of understanding when it's best to be investing for capital and when it's best to be investing for income. And that is the key to successful property investing, and I can tell you quite honestly, I make more money in decreasing markets than I do in increasing markets. So the fact that our property market is going up at the moment is annoying me no end, because I like it going down. But of course that's a professional's view. And one that you will get in time, because there is still an element for people that when the market is going down they feel a bit scared by it, whereas I go, yeah, you know, it's going down. So we'll get there in a few hours time with you for that one. So let's summarise then. Evidence that we're looking at, we want actual evidence. We want real, relevant and what I call recent evidence. So we want the longest term. The longest term of evidence is more resilient. So we've looked over 20 years, we've looked the last year, 20 years, 50 years, 1,000 years. So it gives us the idea of long-term trend. We need to bear in mind that the evidence we're looking for might be different for different property types. We might be looking for different evidence for flats and apartments or houses, or what I call social housing or council housing, housing associations. And with evidence, we want it to be as independent as we can. We don't want the gossip from the pub, or you know, your mate up the road, or your Auntie Flo, bless her cotton socks. We want independent, third-party, qualified evidence. And I've put there as an example RICS, which is the Royal Institute of Chartered Surveyors. They provide valuations, but you know, it doesn't have to be them. But the more qualified and experienced the evidence, the more you can rely on it. Okay, and then when you get to specific properties, you want it relevant and specific to that property or property type. Because obviously one of the reasons the market goes wibble wobble, wibble wobble, wibble wobble all the time is that you might find that family housing is having an up, meanwhile city centre flats are having a down. So the average then provides the wobbles within the market overall. So you start to get good at looking at specific types of evidence. So let's summarise evidence then. If it's general, it's generally worthless. So remember the taxi driver, the man in the pub, your best friend, your Auntie Flo. If they're saying, oh, I heard that last week there was a property selling Station Road and it went for 200,000. Okay, it's not good enough for us. So think about evidence, general evidence. It'll give you a general view, but it's not good enough to rely on for you to pin your money to it. There are also general pieces of evidence that you see all the time on the news, on the telly, on the web, certainly in the newspapers. And I just wanted to talk about these two headlines. This is a headline in one of the national papers in the UK, and it says the house price boom is over. Now that immediately feels like a negative thing. People would think that the market's about to turn, and as an investor it might make you think that I want to now move into income type of strategies rather than the capital ones, because this is a piece of general information launched in the national newspapers. Now we want to compare that with this one, house prices still soaring. Now that gives us an idea that the market is still going up, and if we were to rely on it, we might well stick with capital type strategies. However, let's jump back to this one, and we can see that this was published on Thursday the 31st of May 2007, so the house price boom is apparently over on that day. Meanwhile the house prices are still soaring, and yes, you've guessed it, it's Thursday 31st of May 2007. So and actually these two newspapers are reporting the same piece of research. Okay, so bear in mind this isn't necessarily the best source of information for you, and you know why these headlines are like this, don't you? sells the newspaper, sells the newspaper. You know, these are not property investors, they're selling newspapers. But as a lark, I saw quite recently, last year, in fact, Monday the 1st of April, there's the same newspaper, house prices set to soar. I mean, 6 years later, they're still writing the same headline. I mean, jeepers creepers, get some new information, will you? You know, it's just, anyway. So, actual evidence, be careful of general evidence. It tends to be worthless. I always say, if people are giving you advice for free, it's free because it's worthless generally, and I would include the taxi driver, the man in the pub on that one, or woman in the pub. General, be careful. The newspaper articles, the headlines aren't always really relevant. You can start to get more relevant information when you get onto the web, and there's a website called www.checkmyarea.com, and this is what it is, and it gives you the ability to check what's going on in your area by postcode. So if you slot in a postcode here, and we've taken TN22 in this particular case, but any postcode, any zip code will fit into there, and it will give you some information on what's going on in the area. So it tells you that it's affluent, mature families and couples. So are we going to invest in little one-bedroom flats here? No. Because it wouldn't fit there, would it? So this is so by looking by postcode, it gives you an idea. It's mainly detached and owned, you know, So it gives you information about the area. So again, that can help direct you to the type of investment you might want to make. Then there's more comprehensive data on www.wizardmania.com, and this is Wizardmania, and this is a collative thing. It gives you a lot of information about maps, planning applications, flood risk, crime levels, local housing market, property valuations, schools, commuting times into London, say. So it gives you a lot more detailed information from which you can start to make your assessment. Then we've got very specific information, and we've got Zoopla here, www.zoopla.co.uk, and this is Zoopla, and you can see that it actually gives you information on numbers of properties for sale and the amounts and so on. So if you're looking at a specific property, you can go in and find some comparable information about the same type of properties in the same area by looking at Zoopla. And then we've got very specific, which is mouse price, and if we look at the TN22 postcode again, you can see that it will give you average current values, price earnings ratios, the amount of stock that's available, price trends and so on. So it will give you a lot more detailed information, and then very exact information you get from the Land Registry. We've got www.landregistry.gov.uk, and if you look at the Land Registry, you can actually, any person can download title deeds and a title map of any property, certainly in the UK, by paying a couple of pounds and logging into the Land Registry website, and so you can find out things like boundaries, you can get a site map, you can get a title document showing who owns it. In most cases you can find out if there's a charge on the asset, so if somebody's got a mortgage on it. Now, could that be useful information if you're negotiating a purchase? Absolutely. So although people might be quite circumspect and they might not tell you how much they paid for their house, you can actually just look it up. Okay, it's publicly available information, the price at which property prices are transacted. You can also find out who owns the property, find out where the deeds are, find out about boundaries and fences, and also do things like check average property prices and values in the area. So again, when you get very specific and you're looking at a house on its own, that's what you'd be looking at. Now, as well as all of this, as well as values and trends, there's some other information and evidence we need to be aware of, and we need to be aware of things like income returns. So what's the average income return? So this is a cutout of an article from the Times, and it tells us that buy-to-let returns in this particular case were over 10%. Again, you know, this will change depending on when you're looking at it, but you want some evidence of what the general returns are for other investors from income, so that you've got a target to aim at and a backstop really. It's also useful to know the number of mortgages that are out there. So that's number of mortgage products and types of mortgage products. So we know that the mortgage market, like the property market, goes wibble wobble, jelly on a plate. And sometimes, for example, there aren't many interest-only mortgages available. But now, at this time, as I'm speaking today, there are a lot more interest-only mortgages available than there were. So sometimes you can get loans to value of over 100%. You know, in the boom days, you could get a mortgage of 125% of the value of the property. Now, at the moment, it went down to like 60, 70%. Now we're back up to 80s, 85 again. But it's always useful to know how fluid the mortgage market is, how many different mortgage products there are available, because that gives you an indicator of how easy it's going to be to get the money. We also need to know the amount of mortgages that are being issued and the type, and the Bank of England and the Council of Mortgage Lenders issue these figures on a regular basis. It will tell you how many million or billion has been lent out in terms of mortgages, and it will also tell you how many mortgages were investment type mortgages, first time mortgages, remortgages, so you get an idea of how active the market is on each individual level. We also need to know the numbers and sellers and buyers in the marketplace, because that tells us how strong the demand is going to be for our product. So you tend to get these figures are issued by RICS, the Royal Institute of Chartered Surveyors. You also get these figures issued by estate agency groups and so on, and they will tell you how many sellers and how many buyers they've had in the last month and so on. So you can see that if you've got 5 buyers and 55 sellers, you've got a flooded market, and the reverse would hold true. Also, we need to try and get some evidence on the speed and strength of the sale, because the quicker properties are sold, the stronger you can rely on the fact that prices are probably going up. Because if houses and properties are being sold, you know, like before they've even had a chance to get onto the streets, then you know that there's lots of demand in the marketplace and it's running away. So it gives you the speed of sale and the strength of sale comes from that kind of information. So you can get again information off the web on how quickly the average property sells. So normally it would take something like, certainly in England, it would take about 90 days for a property to sell. If that's down to an average of 27 days, you know that there's strength and demand in the marketplace. The other piece of information that's useful is the asking price to offer price ratio. So normally, if a property's up for sale for say 100,000, it would normally be sold for about 95. So the average offer price or the sales price is normally between 90 and 95% of the first asking price that the seller wants. Now, in times of high demand, it's 100%, and in fact, at times of very high demand, it's over 100%. And you will all have heard the stories where somebody said, "Oh, I put the house up for sale for 200,000, and I had 3 offers at 250 in the afternoon." Now, that is a very fast, aggressive market. Does that make sense? Yeah. So, actually getting those figures of asking to offer price ratio gives you an idea of how strong the market might be. Actual evidence needs to be credible. It needs to be reliable, it needs to be fundamental, so it needs to be useful to you. And there is no point in knee-jerk reactions or rainbow chasing. So I showed you this map a few slides ago. Now, there's absolutely no point in you chasing a rainbow up to Manchester. Manchester was last year's gig, okay? It went up by 21% last year in 2013. Is it going to go up by the most in 2014? Highly unlikely. Highly unlikely. Because what tends to happen is that they have a shoot up and then it steadies off. So it's I would say, if I was going to do anything, is I'd avoid Manchester like the plague, you know, but there might be other evidence, but nonetheless. So there's no point just following Manchester in that case. It's rainbow chasing. You've got to get good at evaluating the fundamental evidence that you've got and working out when the next uptrend is going to be, and we will cover that on one of the next sessions. So we've ticked off actual. We've covered that one, the actual evidence. So let's have a look at the ratio. Now, the ratio is about telling us how affordable property prices are. Now, let's use a simple example, and we have here the average house price at 150 and the average salary at 25. What we do is we divide the average house price by the average salary to get a ratio. So, you know, just have a go at that, you know, noddy ratio there. We've got an average house price of 150. We divide it by 25 and we should come out with the answer of 6. Absolutely, hurrah, we've got there. Now that is an expression of how affordable houses are within that area or the country or the street, depending on where we're doing it, and we need some yardsticks to measure this against. So let's have a think about the impact this ratio has. We have a ratio, an example ratio here of 6. Just think about it. Let's say I'm a lipstick sales lady and I work for one of our major chain of lipstick salespeople, and I earn a salary of $15,000 a year. I like my job, get lots of free lipstick, I'm happy with that, but the average house price is $150,000. So what's the ratio for me personally? 10. But think about my mentality. I'm a lipstick sales lady and I earn $15,000 a year. The average property price is $150,000. I'm going to be sitting there saying, I can't afford that. I can't afford I only earn $15,000. So you immediately know that if the ratio is 10, houses are not very affordable, because you can see that from the emotional evidence. Now let's assume that I get promoted and I'm now area lipstick sales lady, you know, Southern Division, so I've got some big promotion, and I'm now earning $50,000 a year. The average house price is $150,000, so what's the ratio to me now? 3. But think about it, I'm earning $50,000 and the average house is $150. I'm going to say, whoa, I'll have that. In fact, I'll have 2, you know, because I can afford it. So when the number is small, the affordability is good. When the number is big, affordability is bad. And of course, the more affordable housing is, the more demand comes into the marketplace. When demand comes into the marketplace, where are prices going? Up. Absolutely. So think about the affordability emotion. So here's a very specific one. So we've looked at some generic ones, some averages, some made up examples. If we look specifically at a certain area, and we happen to have chosen Blackburn here for no reason apart from it was there, and if we look at that, the ratio is 4.9. Now, we know that 3 is high affordability, 10 is poor affordability. We got a guess that maybe 5 or something in the middle would be average. So we're not terribly sure at the moment yet where Blackburn fits, but it's a figure that we can put on the table, and we can then compare it to other things that we know. Now, if we look at the ratio evidence from 1983, 93, 2003, so we've got 30 years there of ratio evidence. Now you can see how, again, it goes wibble wobble, jelly on a plate, but the long run average on the affordability ratio is about 4.1. Okay, over the last 30 years it's been about 4.1. So if we take that one as our yardstick, Blackburn at 4.9 is on the wrong side of the average, isn't it? Because we want it to be below. Now let's have a think about how we can use that. So any general ratio below 4 means that there is a pressure for prices to come up, because properties are affordable, they are cheap, demand will come into the marketplace, and there will be a pressure for property prices to go up. So if you see that the ratio is below 4-ish, then you know prices are likely to go up. And any specific ratio below the national average would show pressure to go up more in comparison to the country as a whole. So hold on to your trousers, I'm just about to show you a chart that might be a bit scary at first. Now this is the affordability ratio chart. Now we know that 4.3 in this particular case is the UK average. It's 4.3. So it's slightly above our running average of 4.1-ish. But look at it. We've got here like 6.4? 6.4? Of course, where is it? Oh, Londinium. Okay, we're back to London. Now, we all know just from circumstantial evidence that the prices in London are way above what they are in the rest of the UK. So that doesn't and shouldn't surprise us. If we look at the outer metropolitan area, the outer London area and the outer southeast, these ratios are all way above the national average. Now, what does that mean? London, you've got to take London as a separate case because the demand is different. But let's look at the other end of the scale and look at places like Northern Ireland at 3, Scotland at 3.2, Wales is 3.8. If we just look at England and go along the bottom line here, look, we've got an area here where the ratio is 3.2. Now, it's up north, it's northern, but we immediately know that property prices are more affordable up north than they are in the country as a whole. So what we're looking for is that disparity. We're looking for where it's out of kilter, because that immediately tells us or gives us an indication that that might be a good place to invest. Okay, it's because the prices are cheaper than the country as a whole. Everyone happy with ratio? Yeah. Now, let's look at interest rates and why interest rates are important to us. And I've got here the interest rate chart since interest rates were first published in 1694. Now again, you can hear I'm looking at long-term evidence. I'm not looking at fly-by-night superficial stuff. I'm looking at solid long-term trends. Now I can tell you the interest rates from 1694 to date. Now this chart only goes up to 2009, because what's happened since 2009 on our interest rates? Absolutely nothing, okay, because it's stayed at 0.5 ever since. Now you can see different activities here, the world wars, Wall Street crash, and Black Wednesday up here, and you can see that certainly in the UK we had massively high interest rates, you know, in the early 90s certainly. And if we look at that long term, we can get some ideas about what average interest rate we should use. Now we're down to 0.5 now. It's been 0.5 for quite some time. There's some slight indications that it might be going up, but I started my property investing career about here. And I survived all of that, and I survived that, and I survived that, and I'm surviving that. Okay, so the interest rates are another piece of the puzzle. Are they a problem? Because people often say to me, oh, what are we going to do if interest rates go up to 1%? And I say, laugh, because it's great. Because I'm used to investing at 17, 18, even 19% in some cases. And the fact of the matter is, it's just about finding the deals that work at those interest levels. At the moment, I mean, we've never had it so good. Never had it so good. So interest rate tips then. The long-term average interest rates are about 5%. But they're falling below that. The longer we have these low interest rates, the lower the long-term average falls, obviously. And I always tend to use 5% when I'm doing my average calculations on interest rates for that reason, because I know that long-term it's okay. Will they ever go up to 17, 18, 19% again? My answer to that is categorically I don't believe it can do, and certainly there's two main reasons why interest rates won't reach 17, 18, 19% or even 10% again, and that's first of all is the MPC, which is the Monetary Policy Committee. In 1997 in the UK, Gordon Brown, as he was the Chancellor then, introduced the Monetary Policy Committee, and that is an independent body that is responsible for regulating interest rates in this country. Up until then it had been determined by the government of the day. So if there was an election coming, interest rates used to go down, and then once they got re-elected they used to put the interest rates up. So it was politically manipulated before. From 1997 it's been the responsibility of an independent body of people, which does include the Governor of the Bank of England and so on, but it also includes academics and retail people people and different people, and they determine the rate of interest that's issued by the Bank of England. So the Monetary Policy Committee, now they are looking at all kinds of other evidence like inflation and employment and They're not just in it for the short-term political story. So they, I don't believe, will allow interest rates to be manipulated and will go up to 17% again. And in any case, if they did, we would just use our feet and go and get our money from somewhere else. Because if the UK base rate went up to 10, I would just go and get my borrowing in euros from France or Spain. Or I'd get my borrowing in dollars from America or in yen from Japan. Because can you do that? Yeah, of course you can. I mean, if you're going to borrow in a different currency, you've got to take account of the exchange risk and, you know, changes and fluctuations in the exchange rates and so on. But nonetheless, I have total foot power now. It used to be when I first started investing, there were exchange controls on how you could take money in and out of a country and how you could borrow. Not the case anymore. I mean, you can borrow anywhere you like and spend it anywhere you like, more or less, you know, with a few exceptions. So I have foot power. The consumer, the customer has foot power to go and borrow in other currencies. So that's why all of the major currencies like the dollar, the Swiss franc, the euro, sterling, their interest rates are all much of a muchness, because if one got out of kilter with the others, we'd all shoot off somewhere else for our money. So we've got consumer power there. What I do when I'm estimating the potential of any property, I use 5% as an average, but this is a property I bought long ago when the interest rate was 15.9%, and this was a time before buy-to-let mortgages even existed. Prices were very high and it still worked as an investment. So don't get too hung up on it. As I say, I estimate at 5%, 4 to 6% is totally reasonable. And if you estimate that for your investments, you won't go far wrong. But if the prices go up, if interest rates go up, well, you just do a different calculation. That's all. It's not the end of your investing career. Right now, the average mortgage rate in the UK is 2.37, because although the base rate is a half, the mortgage rate is always slightly more, because you've got to get the financial providers have got to get their profit in there, etc., etc. So the average mortgage rate at the moment is 2.37%. Now, I want you to get very excited by that, because this is officially the lowest ever average mortgage rate since records began in 1694. So we have the lowest average mortgage rate in history. So it could not be a better time to start your property investing career than today, because the cost of your fundamental supply is very low. And in fact, in 2009, when the 0.5% bank rate came in, the average was 3.98. So you can see that average mortgage rates have fallen by about 1.5% over the 5 years that we've had the low bank rate. Isn't that amazing? Isn't that amazing? I just love that. I love the fact that I've lived through, excuse me, and invested through the highest ever rates and the lowest ever rates. And I've survived each. And there have been different investment strategies without a shadow of a doubt, but nonetheless, isn't that fantastic? So interest rates are important to us. The next thing I want to look at is demand and supply. Because we know if there's a lot of demand in the marketplace and supply is static, prices are going up. If demand comes out of the marketplace, when supply is static, prices are going down. So understanding demand and supply is fundamental. Understanding it nationally, regionally, locally is also important. Now, let's start with the headline here on the normal demand in the UK, for example. Now, the normal demand was assessed a few years ago at a requirement for 240,000 properties per annum for 10 years to get the housing stock up to a level where it was acceptable. Now, I've got hot off the press, the research was actually published again on 2 days ago and was reported in the papers yesterday. So I'll just read out the update on that particular figure, because it's worth understanding. The UK homes shortfall is now equivalent to a town the size of Birmingham. And this is the report from the Home Builders Federation. About 260,000 new homes need to be built now every year to combat the shortage. So it's gone up from 240,000 to 260,000. Since we made this estimate here, we have built only an average of 115,000 properties a year since that time, and the Home Builders Federation now estimates the country is 1 million homes short of what is needed to adequately house the population. Now that's a phenomenal statistic out only 48 hours ago, so an update from when I created the slide here. So we are 1 million homes short. Now we know that the expanding part of the market is the private rental market, because the social housing is not going to step up to meet this demand, is it? It's not suddenly, they're not going to suddenly build millions more social houses. So this is up to us. It's our responsibility, guys, to fill this gap. The interesting thing, it says here as an aside line, it argues that to actually improve the housing market situation now, work needs to start now on 320,000 homes a year. And that target, 320 homes per year, has only been attained in 4 years out of the last 70. So we don't have a track record of building that much. And since these stats were out, we've built an average of 115,000. So we are way below. Now what that means long term is this, is that supply is nowhere near keeping up with demand. So there is a gap constantly between supply and demand, which always supports property prices in the UK, and that's why we have this long-term upward trend on property prices, because we constantly have this gap between supply and demand. And the supply and demand comes from a variety of areas, because it comes from things like social and demographic change. It comes from things like ageing populations, where the older you are, the less likely you are. The older you are, the more likely you are to live alone, because your partner's shuffled off this mortal coil. So you're more likely to live alone. So people living individually need a lot more houses than people that live in groups. Makes sense. Also, we live alone longer, so we don't get married, we don't live with somebody till much older, so again it creates a lot of single people at the other end of the spectrum who all need to live somewhere, so those parts of the demand are constantly growing. We have a net inflow of population from the EU. Certainly in UK, we have people coming into the UK from around the EU. We have people going out, but it's a net inflow. So again, that part of our demand is constantly increasing. So demand is increasing, supply isn't anywhere keeping up with that increased demand, and that will constantly keep prices supported in the property market. And this is the original report about the 240,000 houses needed per year that came out of the government, and as we know, that has now been updated this week. Now, the next part of demand we want to look at is socially provided housing. Now again, we can see that council waiting lists, social housing waiting lists, are now over 2 million. We know that the social housing availability is dropping. It's down to 17% of accommodation units. So this could give us a strategy. We could actually be buying properties to fulfil the social demand, the social housing demand that we have in this country. So it could be a specific strategy that we have. So as well as general demand, social demand is increasing. This is a website that gives you the number of people that are on council or social housing waiting lists across each borough in London, and you can actually find these statistics for any place anywhere in the UK. So it tells you where the demand specifically is. Oh, this is an interesting one. This is an area of the UK, Stoke-on-Trent, and it's made itself onto the Stoke and Staffordshire News because it's created supply in Stoke. Do you see how many houses, properties they've created? 17! Yay! We've unveiled 17 new bungalows. And they've got all excited about it and put it on the news. Isn't that exciting? So I suppose every little helps. It actually does say here about 3,000 individuals or families in the city are on the waiting list for social housing. So we have an area of demand there. I want to just quickly refer to this about empties, because although we have this massive demand, we also have 737,000 empty properties in the UK. Now, why can't we match the two together? Well, the reason we can't match the two together in the main is because the empties tend to be up north. Okay, they're in the north of England where there's not so much employment, so people are moving down south to get jobs. The supply of housing, the empties, are mainly up north, and the demand is mainly down south. Also, I just want to alert you to these statements here. Sometimes you can get high demand in the market overall, but absolutely no demand for a specific type of property. So a few years ago, they were building city centre flats like they were going out of fashion in all the major towns across the UK. A fair proportion of them have now been turned into office space because they couldn't sell them. Okay, because there was a massive supply of a certain type, but no demand for it. So be alerted to the fact that demand and supply, although they don't match overall across England and lots of places in the world, there will be specific pockets where there is adequate and an abundance of supply. This is an interesting website here, and it will tell us the number of empty properties by area across the whole of the UK. So here we have England, the 737,000 that I referred to, and you can see that the biggest number of that is in the northwest. Okay, 136,000 of the 737 are in the northwest. And of course we know that that area may have become run down, employment isn't so high, people move out to get jobs and so on. So with demand and supply, look at specifics. Look for the locations and look at the demand and supply in the locations you are looking to invest in. Look at housing policies, because certain housing policies, certain areas will be selling off their social housing and some areas will be building their social housing. So look at specific areas and the government's policy there. Get to know the local council and what they're up to and what they're planning to do. And you will find that in certain areas, in order to encourage supply of housing stock from professional investors, from the private landlords, they will provide grants for you to do up the properties, and you'll see a couple of those as we go through. So look for areas where they provide grants. These are just examples of where I've seen grants applied before. Get to know your empty homes officer at your local council. So in order to get to all of this information for the local council, what you do is you go onto the web and you put in www.putthetown-you're-interested-in.gov.uk, so Margate or Doncaster or Stoke in this particular case, and that will get you through to the council website. You'll be able to get all of the information about their housing policies and so on from what's called the UDP, which is the Unitary Development Plan. It will give you information about what housing they're planning to build, what roads they're looking at, schools, all that kind of stuff. And you'll also get through to the housing office there, where you can get to know your local empty homes officer and you can look for grants for refurbishment of properties. Because often the councils will give grants such that they can encourage you to buy properties in their area and do them up so that they've got more housing stock available. So I'll show you a specific example about that later on. So demand and supply, again, there's lots of evidence that you can look at. And here is Stoke, the area that's actually provided 17 bungalows. So no doubt that will be on their UDP at some stage. It doesn't surprise you, I'm sure, to see at the bottom here that local authority have got a grant here of £30,000 loan for people who want to come and live in that area and do properties up to improve the home. homes. So they've got a 30,000 grant there available to people doing up homes. You've got to live in it, so it's not quite an investor-driven thing, but nonetheless you can see that this council is doing something. It's only built 17 bungalows and it's got 30,000 available, but it's doing something. Okay. Now, take a ride. We're very nearly there. The last session we want to look at is employment and the economy. So the E stands for employment and economy. Now, why are we bothered by employment figures? Well, we're bothered by them because if people have jobs, they can afford more housing. If people have jobs, they're more likely to buy, aren't they? Because they've got a regular source of income and they feel more comfortable about committing to a mortgage and buying a property. So again, we need to think about employment in terms of the country overall, but also in terms of local areas, because we've already seen that maybe areas of the northeast, northwest have got a decreasing employment, whereas down south employment is increasing. Overall, we're doing pretty well at the moment. The figures just issued in March 2014 tell us that in the UK our unemployment figure is 2.3 million people. It's been way higher. It's been over 3 million, and those of you that were old enough to remember when Mrs Thatcher was in power, when she got elected for the third time, she stood on the steps of Conservatives' office like this with her handbag over her arm, you know what she was like, doing this, saying, you know, I've been elected for the third time. The next day in the newspapers there was the picture of her standing like that, and underneath was the headline, 3 million unemployed, because we had really high unemployment at the time. So our unemployment has been much higher in recent history. It's actually on its downward slope at the moment. But again, there are sectors within that. We know that we've got high youth unemployment in this country. And do young people rent or buy? Rent. Okay, so again, it gives us a different steer on where we might be going with our investments. With the economy tracker and unemployment, again, you can look on the website and see where areas of high unemployment are. So the darker the colour, the higher the unemployment. You can see that in the southeast and down here it's pretty all light because unemployment is very low. And this actually gives you an option, if you slide it along, to see where the unemployment was and is and isn't and will be. So it gives you a chance to see where the demand is generally. And you can zoom in and so on. So employment is of interest to you because the more people are employed, the more money they have to commit to their housing and so on. Gives you an idea of the strength of the market. So with the employment and the economy, you need to look at employment rates, overall and local and specific, of course. Look at the local economy, look at what jobs are available locally, whether it's for young people, mature people. Think about things like EU investment into areas. About 10 years ago there was massive EU investment in the north of England because our government applied for grants from the EU to boost certain areas of the country, to boost the economy there. So you want to look, I mean, because if the EU are shoveling in 300 million or something to an area, that's going to be a good thing, isn't it? Because it's going to bring the area up in value. We'll talk a bit about that later on. Look at the bigger picture, and I've got here, for example, the GDP figures. Now the GDP figures are the gross domestic product, and that is evidence of the output. It's a figure that tells us how much the country as a whole is producing. So if our GDP is increasing, our economy is increasing. Does that make sense to everybody? Now, if we look at the GDP for last year, the gross domestic product, the gross domestic output for the UK in 2013 for the year overall was 1.9%. Now, that was a pretty good result. Hooray! It's the best result we've had since 2007, but even better than that, we were one of the biggest growing countries in Europe, and our future expected forecasted GDP is expected to be quite significantly above that of most of the rest of mainland Europe. And how does that in fact affect our property purchases? Well, if we look at, this is the GDP map for Europe in 2013, and you can see that this lovely sort of beigey colour picks us up because we were 1.9% up there, so 1.9% growth here. We were the same as Germany and France. Southern Europe, we know, had a more difficult time, so they were negative there. So that's where we stand at the moment. Now the forecast going forward looks like this. Now England has gone green, and I don't mean they're environmentally friendly necessarily, but they've moved into this bracket, 2 to 3.9, and figures that were out recently indicate that our GDP may even go above that. Whereas the rest of Europe, Southern Europe has gone neutral, and the rest of mainland Europe more or less is still stuck in here. Now what does that do to the UK property market? It's interesting. It immediately tells us that we are likely to start getting more demand coming in from the rest of Europe, because if we have an expanding economy, we've got jobs, we've got low unemployment, people are coming from Croatia and Hungary and France and Poland and whatever into our country to get work. So it immediately drives more demand into our country. Now the key there is to take action on it, because if you think about the people that are coming into the UK from these kind of areas, where do they live? They tend to live in HMOs, certainly initially houses of multiple occupation, and they come over and they live in these big houses of HMOs, and they send money back to their families. And I've got quite a few tenants that do that, and bless their cotton socks, you know, what a lovely thing to do. But they come here to get jobs and employment and send money back. Now that immediately sets up a potential investment strategy for us, because if we followed this through to its logical conclusion, we did all the evidence, we checked everything, we could actually buy an HMO just to fulfill that single piece of demand, that single piece of news. So you can hear the bigger picture, how all of these figures are useful. And you often hear me, in the newsletters and on the webinars and so on, talking about things like the GDP. And you're probably sitting there thinking, oh, yaddy, 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 what's that got to do with anything? But actually it does have quite a big impact on the property market overall. So there we have it. We've been through Take a Ride. We've looked at actual evidence, and how good that needs to be, the affordability ratio, interest rates and the impact that has on our investing, demand and supply and the impact it has there, and then finally we've looked at the employment situation and the economy. So do we now know enough to be able to assess the property market itself? In some senses we probably already know too much, because we've got lots of different pieces of information to look at there. So are we giving that a tick? Have we covered that one? So we covered the first one, how to assess the property market itself, and I think we can now have a break.